Hello and welcome to this lecture on the bank lending channel of monetary policy. In this class, we examine how monetary policy affects credit supply from banks. We will discuss three mechanisms: net interest rate margin, reserves, and deposits. Consider the business model of a bank. A bank borrows short-term from depositors and money market funds and uses these funds to originate longer-term loans. Since short-term interest rates are usually lower than long-term interest rates, the bank makes money by exploiting this difference between short-term and long-term interest rates. The difference between net interest income of banks from loans and mortgages and interest expenses paid by the banks to depositors is called the net interest margin. The net interest margin measures the profitability of a bank. The larger the net interest margin, the higher the profits. This graph shows you the net interest margins of banks in the United States since the 1980s. As you can see, the net interest margin of banks has decreased over time. At the same time, you can see that the net interest margin significantly increases around 2010, when the Federal Reserve cut the federal funds rate to zero for the first time. Let's see how monetary policy affects the net interest margin in a simple example. Consider a bank that is entirely funded by deposits worth $100. The interest rate on deposits is 2%, so total interest expenses are $2. The bank has issued one $100 fixed-rate mortgage that pays 5% interest. The interest income is $5, less $2 interest expenses gives you a net interest margin of $3 or 3%. Now assume that the Federal Reserve increases the federal funds rate from 2% to 3%. Since the market for federal funds is an overnight lending market, all other overnight and short-term interest rates will increase. Deposits are redeemable on demand and as such are very similar to overnight loans. If a bank does not want to lose deposits, the bank will have to increase the deposit rate accordingly. So the bank has to pay 3% for its deposits, but the interest rate on the fixed-rate mortgage has not changed. The net interest margin therefore falls from 3% to 2%. A falling net interest margin means lower profits. Lower profits in turn mean less capital for new loans. In other words, monetary policy directly affects bank profits and therefore credit supply of banks. Of course, how strongly monetary policy impacts profits depends on the share of fixed-rate loans a bank has on its balance sheet. Some loans, such as loans to firms, are typically floating interest rate loans, and hence the net interest margin on these loans is not affected by monetary policy. The second way monetary policy affects banks is through reserves held by banks in their Federal Reserve accounts. Those are called federal funds. When the Federal Reserve raises the federal funds rate, it typically does so by conducting open market operations. That is, the Federal Reserve sells securities to banks. The banks pay for the purchases of securities with reserves. With less reserves available in the federal fund market, credit supply in this short-term funding market goes down. Banks use the federal funds market for short-term liquidity needs, for instance when issuing loans. Of course, banks can also borrow in other markets, but often that funding is more expensive or requires collateral, like for instance the repo market. When there's less funding available to banks, or the remaining available funding is more expensive, then banks reduce their credit supply. Hence, monetary policy reduces the credit supply of banks by reducing reserves. Another way banks are affected by monetary policy is through deposits. Recall the simple example I gave for the net interest margin? In that example, the banks matched the increases in the federal funds rate. However, as most of you know from your checking and savings accounts, banks are usually not fast when it comes to increases in interest rates on checking and savings accounts. Most depositors tend to not look for investment alternatives because it takes time. It takes even more time to switch banks because you have to change all your bank information everywhere. So, even though depositors have alternatives, most find it too costly or too tedious to take advantage of these alternatives. This is why retail deposits are referred to as sticky and not sensitive to interest rates. However, some depositors, especially those with sizable deposits, do switch. They tend to withdraw their deposits from banks when the difference between the deposit rate and interest rates on alternative investments increases. The closest substitute to deposits are money market mutual funds. The graph shows total assets of money market mutual funds and the federal funds rate. As you can see, when the Federal Reserve increases the federal funds rate, for instance between 2004 and 2006, or 2016 and 2019, assets of money market mutual funds grew much faster. The reduction in deposits also means that banks have less funding and hence have to reduce their credit supply. You may wonder why this behavior is optimal for banks. Banks face a choice between losing some deposits and foregoing some opportunities to originate loans and increasing interest rates on all deposits. Put differently, would you rather lose 5% of deposits and originate 5% less loans, or increase the interest rates on all deposits by 1 percentage point and keep your current pace of lending? Recent research suggests that banks are strategic about where they increase deposit rates. Within the United States, deposit rates tend to increase faster in places where there is more bank competition. This suggests that the easier it is to switch banks, the more banks have to respond to changes in interest rates to retain their deposits. The flip side of this finding is that in places or countries with highly concentrated banking system, this deposit channel of monetary policy is less important. What have we learned in this lesson? Monetary policy affects banks through 3 channels. First, increases in the federal funds rate compresses the net interest margin, reducing profits. Second, increases in the federal funds rate reduce reserves available in the banking system. Third, increases in the federal funds rate lead to an outflow of deposits, reducing bank funds. All 3 channels imply that increases in the federal funds rate reduce the overall supply of credit by banks.